Imagine waking up on a random Tuesday morning without the sound of an alarm. You walk to the kitchen and pour your first cup of coffee while the house is still quiet. You open your laptop and check your investment accounts, just like you do every week. But this morning something feels different. You look at the numbers and realize that while you were sleeping, your portfolio grew by $412. Then you think about your job. After taxes, your take-home pay for a full day of hard work is about $320. In one single day, your money made more than you did. This is not a lucky break or a temporary fluke in the market. This is happening more and more frequently as the months go by. Your investment returns are starting to consistently outpace your salary. You realize that theoretically you could decide not to show up for work tomorrow. You would still have money coming in to cover your life. You might not be a multi-millionaire yet, but the lines are finally starting to cross. Your money is officially working harder than you are. This specific moment has a name. It is called the crossover point. It is the most important milestone in your financial life. Yet most people will work for 40 years and never even know this moment exists. They will trade their limited time for paper currency until they are 60-5 years old. They will hope that Social Security and whatever they manage to save is enough to survive. But there is another path available to you right now. It is a mathematical inevitability that changes how you see every dollar you earn. If you feel like you are running on a treadmill that keeps speeding up, this is for you. If you are obsessed with the idea of true freedom but feel lost in vague advice, this is the answer. We are not talking about budgeting apps or how to save $5 on a latte. We are talking about a specific date on the calendar. A date that you can calculate today where you officially win the game of capitalism. The crossover point is powerful because it is not a philosophy or a mindset hack. It is a calculable and predictable point that you will reach if you follow the logic. The concept was first made famous decades ago, but it is more relevant now than ever. There are two financial lines in your life that are constantly moving. The first line represents your expenses, which is what it costs you to live each month. This includes your mortgage, your rent, and your food and insurance and transportation. For the average household in America, this number is between $5,000 and $6,000. The second line represents your investment income. This is the money generated passively through dividends and interest and growth. For most people starting their journey, this line is flat at zero. Maybe you have a few $1,000s in a savings account turning a tiny bit of interest. That is not enough to move the needle. But as you invest consistently over time, that second line starts to curve upward. At first, the growth is slow and almost invisible to the naked eye. But compound interest is an exponential function, which means the growth accelerates. The investment income line does not rise in a straight diagonal path. It rises in a curve that gets steeper and steeper the longer you stay in the game. The crossover point is the exact second when your income line crosses above your expense line. It is when the passive cash flow from your portfolio exceeds what you need to live. At this point, work becomes a choice rather than a necessity for survival. Let us put some real numbers on this because the math is where it gets interesting. Let us say your monthly expenses are $4,000. That means you need $40 minus $8,000 per year to maintain your lifestyle. There is a widely accepted rule in finance called the 4% rule. This rule suggests how much you can sustainably pull from a portfolio every year. To generate $40 minus $8,000 annually, you would need $1.2 million invested. $1.2 million is your personal crossover point number. I know what you are thinking right now. You might think that $1.2 million is an impossible goal. But let us actually run the math on how long it takes to get there. If you are 30 years old and you invest $500 a month at an average return of 8%, here is what happens. After 10 years, you would have around $90 minus $1,000. Your annual investment income would be about $30 minus $600. That is only $300 per month, which barely makes a dent in your bills. The lines are nowhere close to crossing at this stage. But if you keep going for 20 years, you would have $270 minus $5,000. Now you are generating about $900 per month passively. The gap is still there, but it is closing much faster than before. After 30 years, you would have $670,000. Suddenly, you are generating over $2,000 every single month without working. You are now over halfway to your crossover point. At this rate, you would hit your full goal of $1.2 million around age 60 minus 5. This is the traditional path to retirement that most people follow. But what if I told you that this is the slow path? The crossover point is not a fixed destination that you have to wait decades for. It is a function of two variables, which are your portfolio and your expenses. Reducing your expenses moves the crossover point from both directions at the same time. If you optimize your life and get your expenses down to $3,000 a month, your target drops. Now your crossover number is only $900,000 instead of $1.2 million. You just knocked $300,000 off your target. That simple change saves you about 7 years of labor. It gets even better because when your expenses are lower, you have more money to invest. If you invest $1,000 a month instead of 500, you hit the target much sooner. You could be crossing over at age 50 minus 5 instead of 60 minus 5. You just bought yourself 10 years of your life back by making two adjustments. You decided to spend less and invest more. Most people underestimate the massive leverage they have over their own timeline. If you decide to be radical and eliminate a large housing payment, your goal drops even further. If your expenses are only $2,000 a month, your crossover number is $600,000. At $1,000 invested per month, you would hit that in about 18 years. You could be financially independent in your late 40s. The crossover point is a mathematical certainty that you can dramatically accelerate. There's also a psychological shift that happens as you approach this point. Most financial advice focuses only on the numbers, but the mental change is just as big. When you first start, every dollar you invest feels like a painful sacrifice. It is money you could be spending on things you want right now. The amounts feel trivial and the progress feels impossibly slow. But something shifts once your portfolio reaches about $100,000. Suddenly, the portfolio feels real and the gains are no longer just a few dollars. 80% gain on a large account is thousands of dollars in a single day. You start to viscerally feel the power of compound interest working for you. Your money is finally alive and it is doing something productive. Your relationship to your job starts to change even before the lines fully cross. I call this the freedom gradient. Financial independence is not a binary switch where you are either a slave or you are free. As your investment income grows, you become incrementally more free every single day. When your investments cover your car payment, you are a little bit free. When they cover your groceries and your utilities, you have more power to say no. Each milestone gives you more bargaining power and more ability to walk away from stress. There is another concept called coast fire that you should understand. This is the point where you have invested enough that you can stop adding more money. Compound interest alone will grow your portfolio to your target by the time you retire. If you have $150,000 invested at age 30, you might be a coast fire. You could stop saving aggressively and use your income for experiences instead. Your future retirement is already mathematically locked in. You have punched your ticket and the pressure is gone. A recent survey found that over half of Americans believe they will never retire comfortably. But most of those people have never actually calculated their crossover point. They are vaguely worried about an undefined future, which is psychologically paralyzing. Specific goal setting is a cure for that anxiety. You might worry about market volatility or high inflation, and those are fair concerns. The path to the crossover point is never a perfectly straight line. You will experience market downturns where your portfolio drops by 20 or 30%. This is normal and it is expected in a long-term strategy. The key is that you are not withdrawing money during the accumulation phase. When the market crashes, you are actually buying more shares at lower prices. This accelerates your progress, even though the balance looks lower for a while. Dollar cost averaging through a downturn is the most powerful wealth-building mechanism. It only works if you do not panic and sell your assets. This is why understanding the math is so important for your mental health. You are not tracking your accounts for entertainment. You are watching the gap between two lines slowly close over time. As for inflation, the 4% rule was designed to account for rising prices. Your crossover number will rise with inflation, but your stock portfolio will likely rise even faster. The alternative to this strategy is to remain completely dependent on your labor. Staying dependent on a job until you physically cannot work is the real risk. You are trading investment risk for health risk and labor market risk. The crossover point gives you a plan that has worked for everyone who stays consistent. Here is what you need to do with this information today. First, calculate your actual monthly expenses by looking at your bank statements. Be honest with yourself about what you are spending. Second, multiply that monthly number by 12 and then multiply by 20 minus 5. That is your crossover point number. Third, check your current investment balance and subtract it from that target. This is your gap. Fourth, figure out how many years it will take to close the gap at your current rate. Finally, ask yourself how you can speed up the process. Could you increase your income or cut a few vampire costs that do not bring you joy? Every $1,000 you invest is $40 of passive income for the rest of your life. Every $100 you cut from your budget is $30,000 less you need to save. Every purchase you make has two different costs. There is the money you spend and there is the time you sacrifice. When you buy a $30,000 car instead of a $15,000 car, you pay twice. You are pushing your crossover point further into the future. That extra $15,000 would have doubled every 7 to 9 years. It could have been worth over $100,000 by the time you retire. That car upgrade might have cost you 2 years of your freedom. I am not saying you should never spend money on things you love. I am saying you must understand the trade-off. Money is not just paper, it is your future time. It is the months you will spend working when you could have been free to travel or be with family. The crossover point makes this trade-off visible and measurable. Once you see the lines crossing, you can never unsee them. Every financial decision becomes a question of whether you are moving toward freedom or away from it. The average person will earn millions over their lifetime and end up with almost nothing. They worked for 40-5 years and have no assets to show for it. The crossover point offers you a different path. It is a clear path of saving aggressively and investing consistently. If you wait for the math to work, the lines will cross. They always do for those who have the patience to stay in the game. One day, you will wake up on a random Tuesday and realize you are finally free. Your money is working harder than you are, and everything changes in that moment. Calculate your number today and start closing the gap.